Hi, we're back here at the Expo in Dubai, the Forex Expo in Dubai. This time talking about all things trading, whether it comes down to what strategy you employ, what's right for you, psychology, risk management, and a lot more. This time around, I'm joined once again by Mohammed Yakut, and we've also got Sol Knapp, who is the MD of Futures and Options. I think you're probably the most experienced out of the lot of us. You're a bit older than us, just a smidge. I guess from our perspective as market analysts, we have got experience, of course, in the markets, talking markets, educating around trading. But I guess from your perspective, I'd like to dig a little bit into exactly what your background is and where you come from in all this.
Yeah, sure. So I started my career back in 1992. So yes, you're right, I'm a little bit older than you guys. I started on the life floor in London, so an open outcry exchange, where I was a runner. Started off as a yellow jacket, basically a clerk, and then became a trader and traded in the Bund pit, which is a 10-year government bond pit. I started from there, and then once all the trading went screen-based, I migrated over to the screens and traded on Eurex, traded the same products, and then as more exchanges come online, I sort of started migrating across to other exchanges and trading across all different exchanges that were offered on electronically.
Amazing. I mean, I guess the first thing hearing that makes me think is the difference between people that trade one single market and that trade everything. I mean, certainly in the world we live in nowadays, you have so many options in terms of what you trade. Some people always employ the sort of idea that they just focus on one single market. Some people like the idea that they can just trade according to what they see on the day. What do you prefer personally now that you're in a different
I mean, originally
role?
I was, a one market trader. I traded government bonds, 2 years, 5 years, 10 years. As systems improved, as connectivity improved, I started to be more sort of multi-asset traded, indices, oil, lots of different energy products, soft commodities. For me now, I prefer if I was to trade, I don't actually actively trade as much now. I would be an event trader, so I would just trade mainly news releases, surprise events, which can have a real big impact on market movements quite quickly.
And again, that's another side where there's different types of traders, right? In terms of some people love to trade around the news, some people hate trading around the news. What's your perspective, Mohammed?
I'm not a news trader. I don't believe I can trade the news because I'm not the US government. Let's say we're talking about the NFB. I don't really know, or I will not be putting my money on based on news. I don't really know how it will come out and whether those news have been priced in markets beforehand or not. So for me, I would love to have a look on news to understand after the fact what happened. But in order for me to trade the news, no, I think it's a high-risk trading style. And it's not, I can say, it's not trading more than like gambling because you don't really know how markets could react to any news and you don't even know the news. So when we talk about the important NFB data that's coming out monthly, or even inflation numbers or whatever it is, maybe the Federal Reserve, sometimes I can trade with the FOMC meeting or the FOMC because most probably the FOMC could be expected, like Jerome Powell can do this and that, they can keep interest rates or reduce it or whatever. And that also gets risky when the press conference starts, right? Because any one single comment can just change the overall market. So I'm not a big fan of news trading, and I don't believe it's sustainable because, you can make profits once and twice, but if we are in markets, we're looking for continuity. We're looking for, okay, I made profits today, I want to make profits by the end of the month and by the end of the year. It's a long process. So is it something that's really sustainable, trading news? I don't really believe so.
It's funny though, because I guess that comes down to like what is one person's style of trading that can make them money could be the complete opposite of what the next person believes is right for them. I certainly, went through periods in the past where I was thinking, I really want to trade around these events because that's where you see high volatility, right? But you end up drilling down in particular, let's say in the aftermath of, say, a payrolls figure that was a major miss or beat. You can often see markets move heavily in one direction. It completely reverses. It goes much lower, for example, and ends up back where it began. Everyone's been hit on the way and we're just back at the starting place. So it can be very volatile, which is a benefit, and everyone's looking for volatility. People don't want to sit on positions for really long periods of time. But at the same time, if it's sort of multi-directional volatility, it can be very difficult for traders. So whilst we a lot of the time talk about events and talk about, oh, how you could trade this event, how you could trade a payrolls release, how you could trade CPI. I think at the same time, it's worth noting that you can trade it if that works for you, but also you just need to be aware of it as something that you either trade or take risk off to then see in the aftermath, because that's the kind of event that not just shapes markets at that moment, but also can be the catalyst for a period going forward. You know, say 3 weeks later, you could still be talking about, well, that last CPI number came in at X, Y, and Z, or, you know, now we're talking about ADP because the payrolls figure's not come out because of the shutdown. In terms of sort of strategies, do you think that this one's to you, so do you think that strategies for a trade area are the most important thing? Do you think you can overcomplicate things, or you think that that's the thing that you should really try to hone and try and find your edge?
I think you can definitely overcomplicate it, and sort of trading for nearly 30 years and training probably, I would say, in excess of 1,000 traders and coming through the doors. You know, when we had big proprietary trading firms, I think the main thing is discipline, and it is. We used to say have a plan. You know, plan your trade your plan, and you can have a strategy where if this happens, you do this. If this happens, you do this. I think the most important thing is your own psychology around risk management. You know, trading out for a loss on a trade is sometimes, it's a bad feeling to take a loss, but sometimes taking a quick loss, a small loss, is obviously better than taking a big loss. But I think, and I totally agree with what Mohammed said, trading around numbers, I sort of probably maybe interpret that a little bit. I wouldn't trade the actual number, and exactly what you said, like on a non-farm payroll figure, I would wait for the number to come out and then wait for the revisions for the previous month. And sometimes that revision is what causes that opposite move, and it's, as you said, a sustained move. And things like central bank speakers, especially the ECB and Fed, I wouldn't trade the initial announcement. As you say, normally it's marked, it's already factored in, it's already considered, but it can be the press conferences afterwards, and we look for the language that's used, and a change in the language or a change in the tone.
Well, I guess that highlights the fact that when we talk about news trading, it can be the news that's on your economic calendar. It can be the aftermath of that. Let's say the Fed announcement comes out, but actually the market movements might come from some of the wording around that afterwards at the presser. Or it can be something that's completely left field. And a lot of the time there's talk of like, oh, the algorithms are set up in a way that if this word and this word said in this context, then the markets buy or sell in accordance with that. In terms of sort of policies, not policies, but sort of strategies and technical analysis versus fundamental analysis, where do you lie in that kind of conversation?
I basically lie in the middle between both, because I pretty much love technical analysis, and I believe that technical analysis is really powerful when you understand a little bit about it. However, the fundamental picture is everything. You know, the trend is your friend. We all know this, but you would be shocked with how little traders actually follow this concept. Traders don't follow the trend. They don't check the daily time frame for the major trend, and they always, you know, get caught up with the noise on these shorter time frames, and they forget about the bigger picture. So my idea is the fundamental analysis is really important to know this major trend, and when it can shift. Let's say the Federal Reserve is changing the monetary policy, or a certain bank is reversing the course or something. This major trend can change. If it doesn't change, you will and you should trade with the trend. And then technical analysis is pretty much simple to follow on the shorter time frames. Okay, if I'm looking for buys because the daily time frame is just moving up, which is the best price to enter on the 4-hour time frame or the 1-hour time frame? Using the stop loss on technical analysis, you can define or choose the perfect entry for you, and at the end you are following the trend. Maybe you can get stopped out once or twice, but if you are actually following the trend, the more wins will be in your favor.
Yeah, no, it makes a lot of sense, and ultimately when you're looking at sort of trading strategies, you know, you've got to look from the perspective of, you know, what's potentially changing the trend. So, okay, generally we look at markets as being sort of range-bound markets or trending markets, and sometimes they're neither, right? Sometimes they're just all over the place. And we try to understand exactly which the clear trends are and which ones don't necessarily have that right environment, and that can lead you in terms of choosing exactly what market to trade. I think what's interesting also from my perspective is you know, you're talking about the different kind of announcements that might come out. I always like to try and look at the different changes in terms of whether it's data, tonality around different events and the like, and try to gauge in my mind and put it almost on a scale in terms of how much is this going to actually change markets from a long-term perspective, right? Because generally there's a number of sort of underlying trends that are going to be driving markets. One of the key ones at the moment that I think is a great one, and it's part in my mind why gold's doing so well, is this story around debt and the constant rise of debt and the undermining of treasuries in the likes of the US and the Western world. The reason I like that story is it's so difficult for any government to actually reverse course in terms of this upward trajectory of debt that we've seen from a government level in the wake of the pandemic. Everyone's ramped up spending. Anyone that tries to come in on a ticket of cutting back on spending or raising taxes pretty much just get pushed out. So politically, it's not going down very well. So I don't really see where that ends. I mean, I just see debt rising and rising and rising, and maybe they try to find a way to sort of manipulate the financial markets in terms of maybe new QE, perhaps, to then pay for the debt, or you just see higher yields. I don't know. It's just an interesting one that I think of in terms of, you know, you have the trend on the chart, but also what's the kind of thing from a news perspective that's actually going to drive these moves for a long period of time. So certainly when you're looking at a news event, yes, you can say, oh, this came in hot, this came in cold, CPI just rose 0.1 or whatever, and you might get your reaction, but how long is that reaction going to last? So you need to be able to try and understand whether this thing that you've just seen is actually the kind of thing that is going to have a sustained change in terms of the market sentiment around that move. You'd mentioned previously about the sort of having the right mindset. And I think psychology is probably the thing when I first got into trading, I definitely ignored, right? Because I was thinking all I need to know is like, you know, it's patterns and I need to know exactly what patterns I need to do. And then I started moving on to risk management. I think psychology was probably the part that I missed out. And then, you know, fast forward maybe a decade and I started thinking maybe it's the most important thing of the lot. And certainly the Turtle Traders book and sort of experiment was probably a very good example of that, because it wasn't to say that they gave them a really complex set of rules. It was the ability to follow those rules without necessarily cutting your trade short or, you know, getting into trades because you're chasing a loss. You know, from a sort of psychological element, how important do you think that is for anyone that you're teaching trading?
It's always overlooked by new traders and by people in general. You know, human psychology is in some respects, as a trader, our biggest flaw. And I think it's the most important thing in trading is your discipline, your psychology, how you feel on the day, how you're prepared. I think you have to go into trading with an open mind that it's never going to be the same. Every day is different. Every day has different participants, different events happening. But you have to have a set of rules for yourself, especially around risk management, where you're stopping yourself out. It's so easy to get into a bad trade and add to it and then say, oh, you know, it will come back a little bit. And then all of a sudden your stop loss is well surpassed and you think, well, I'm in the trade now, I might as well carry on. And this is how you blow an account, or, you know, you cause yourself a problem. So I think being disciplined, knowing where your exits are, where your stop is, where your targets are, and just be disciplined with your entries. If the market, you know, the market will always be there. The market will move. The market will trade. It will trade tomorrow. It will trade next week. Wait for your setup to become apparent, and then when it's apparent and it's there, execute your setup. If you go to the market all the time just to trade for the sake of it, you'll find it very difficult, and you'll never come out on top.
Yeah, it's interesting. I think, you know, like you say, the psychological element is also tied up very closely with the sort of risk management side of things. And I've certainly met plenty of people that say with pride, oh, I never use a stop loss. And I don't know. I mean, look, I can't tell you that you should trade on a long term or short term or use fundamental or technical, because there's a million and one ways to skin a cat. But what I do know is if you don't have a stop loss and something happens, I don't know, heaven forbid a 9/11, right? I remember that day, and I remember how quickly the markets moved in one direction that continued to move in that direction. If you don't have a stop loss, you might not have an account anymore. And, you know, it's all well and good if you're just constantly topping up your account with small amounts and then just blowing it and topping it up. But if you have a large account, you know, to me, that is asking for trouble. Yeah, from a sort of risk management perspective, how do you see things, Mohamed? Do you have a particular way of looking at it?
I see things or risk management as a percentage of the capital, okay? So let's say if a trader trades with $10,000 account, okay, you should decide the volume or the size of your trade according to the percentage of that you're willing to lose. What usually traders do is, okay, there is my stop loss. Even traders who use stop loss, they say, my stop loss is, let's say, 50 or 100 pips. But they don't really know, they didn't calculate what's the volume of the trade, so they don't really know how much they would be risking in those 100 pips, because the bigger the volume, of course, the higher the risk. So I always use the risk calculator or the lot size calculator, because if I'm going to risk 100 pips, how much does this translate into in terms of money? Like, I'm not willing to risk more than, let's say, 10% of the account, which is a huge amount. I usually recommend like 1 or 2% only, because if you're working with the advisable 2-to-1 risk to reward ratio, you're risking, let's say, $100 for $100 or $200 gain. So this is how I see risk management. You should calculate your risk first, and then this will eventually give you the expected profit. I always love, some people say, take the profit when you see it. Let's say your trade starts moving into the green and you're starting to have profit. I don't usually advise to close the trade, because if you close it, don't cut it short, just leave it, but put yourself into the break even as much as possible. Okay, now my risk is, or my trade is risk-free, and it can just go as long as it goes, and I trade the take profit with me. Let's say I entered into the position hoping for 100 pips. Let's say I am into a good trend and it's moving more. Why would I leave this profit on the table? I would just trade my take profit, not only trade the stop loss, but also trade the take profit to guarantee or book some of the profits until I eventually get stopped out. So I believe traders usually focus more on technical analysis. Believe me, technical analysis is the easiest out of the 3 pillars of a successful trading, which is technical analysis, risk management, and the psychology. Analysis is usually the easiest. I can say 1 or 2 strategies. Most strategies work in a way or another. They have a good percentage if applied on a long time frame. A simple toss for a coin, if applied with a good risk-to-reward ratio, it can make you money. So analysis is easy. Risk management is a set of rules, but the discipline that it takes you to apply this again and again through losses and wins is what makes a successful trading, in my opinion.
It's funny because, this whole discussion about 1%, 2%, 3%, 5%, 10%, I'll tell you, when I first got into trading, I was doing 100%. I just wanted to double my account and double it. It was like every trade I wanted to triple my account in a day, right? And many a blown up account later, you start thinking this isn't sustainable really, because you do have periods where you're doing very well and suddenly you want to tell everyone down the pub how you've just turned 1,000 into 10,000. Great, but then that 10,000 turns to nothing within a few days after that conversation. And I think a lot more now, because of course this type of trading is sort of on one end of the spectrum. Another end of the spectrum is investing, of course. There's a lot of talk about compound interest. And more recently, I think, from the sort of 1%, 2%, 3% perspective of thinking, well, if as an investor you manage to get 6% in a month, that's a really good return. You compound that over a period of time and you're in the game, not only because you're not trading to these extremes in terms of percentages, but also the returns can be really good if you can actually stay in the game and be relatively consistent with your returns. We don't really have much more time. So I guess to wrap it up, I just wanted to know whether you guys had a particular indicator or tool that you sort of live and die by. I feel like everyone has their own little thing.
I like, spread trading is one of my things, like the oil curve and the energy curves. And it's an old school tool, it's been around forever, and it's market profile. It's a visual representation of, it's better than a chart for me because I can see a pattern, a shape. I just find that gives me...
So is that volume at certain price levels, right?
Price. And it just resonates with me, that particular study. I can see it.
Yeah. What about you, Mohamed?
Yeah. For me, it's all about momentum, because on any price chart you have the price and you have time. However, if you can somehow relate the price moves in relation to time, which is the speed of how prices move, it can show you the underlying supply and demand. Let's say prices are going up. but are they going up like $10 per hour or $20? This difference in speed, which is momentum, shows you the power of the current move and whether it will continue or not. And I'm basically, I'm a simple support and resistance trader. However, how can I know that this support is going to be broken? It's all about the speed of the price approaching this. Are still sellers in control and they will just continue below the support, or maybe the momentum is loosening or weakening as they approach support, and now I can expect that maybe this support will hold. So it's all about price momentum for me. It's the third dimension on any price chart.
There you go, and I also have a different perspective because I live and die by Fibonacci's. So anytime I see a 76.4 respected perfectly, there's something inside of me is warmed. So a lot of the time I'll be looking at sort of ABC style Elliott wave corrections into those deep retracements and then looking to take trades around there. So many a way to skin a cat, as we said. Thanks a lot to Sol and to Mohanad for this conversation. We'll be covering this and much more over the course of the second day here at the Forex Expo in Dubai. Thanks a lot for joining us.